We're ready to roll. We're live on all the media that we can be. So.
All right, great. Thanks, Nick. Yeah, so I think everybody is starting to log back on. I guess we had a short interruption there in the Zoom meeting. So we're going to continue with our next paper, which is real credit cycles, and the presenter is Stephen Terry, and he's already shared his slides. So Stephen, go ahead. You've got 20 minutes.
Thanks so much, Tim, and thanks to the organizers for putting together this program. It's a pleasure to talk about real credit cycles. So this is joint with Pedro, Nicola, and Andrei. And this is a project that's easy to motivate with a simple visual fact. In particular, this is a bin scatter drawn from a sample of microdata on US public firms that I'll describe in more detail shortly. And on the horizontal axis, I've got for some fiscal year T, a measure of firm profits or earnings or net income. And on the vertical axis, I've got earnings forecast errors for these firms in year T+1. So realized profits minus predictions that the firms make about their own profits publicly in year T plus, or for year T+1 in year T. Okay, so profits today are correlated negatively with future forecast errors. This is a pattern that in this literature is termed forecast overreaction. What does it mean mechanically? What it means is that when we're further to the right here with firms that are earning higher profits today during good times, firms are systematically over-optimistic or more likely to be disappointed with lower forecast errors in the future. Vice versa during bad times, firms are systematically overly pessimistic and likely to be surprised on the upside. So this type of future forecast error predictability, I just kind of want to note right off the bat, is not the type of thing that's consistent with full information, rational expectation belief systems in which predictable variation of this sort should be incorporated into forecasts. Okay, so what are we doing in this paper? We're doing 4 things. First thing I'll do is I'll tell you a bit more about the data, and I'll formalize the types of forecast overreaction patterns we just saw, and I'll show that in a range of definitions of what it means to be in a good time. Not just when firms are earning high profits, but when at the micro level, firms are investing a lot, when they're issuing a lot of debt, when they're making optimistic or high profit forecasts, firms are systematically likely to be over optimistic and more disappointed in future, vice versa during bad times. Then we'll also show evidence for something idiosyncratic that we can call credit cycles at the firm level. In particular, we'll show that when predictably over-optimistic firms see outcomes reversed relative to their optimistic beliefs, we also see reversals in things like their bond returns and credit spreads in real investment, potentially linking these types of belief dynamics to reversals in real and financial outcomes at the disaggregated level. So these are just facts that the paper starts off with. I haven't yet put an interpretation on them or a model in place, and that's what the second part of the paper does. In particular, to kind of understand whether micro overreaction might be linked to macro reversals, what we're going to build is a rich but canonical heterogeneous firms model of business cycles in which I have a distribution of firm heterogeneity with firms subject to their micro TFP shocks, as well as a driving macro TFP shock. These firms are making investment choices as well as choices about issuance of risky debt on which they can default. That debt is priced and credit spreads incorporate the possibility of default by these firms. So, those pieces, although they're rich, and they're kind of part of this benchmark workhorse heterogeneous firms macro finance model, those pieces don't reflect the novel component of the model, which is one novelty. We make one step away from that canonical structure, and we endow the decision makers in this model with diagnostic expectations, a particular micro-founded departure from rational beliefs that, in this case, manifests itself as overreaction of beliefs in the direction of recent news. So in the third step of the paper, once this model's on the table, we want to quantify it. Okay, and so we're going to structurally estimate not only the standard fundamental and financial parameters of the model, but crucially also a parameter governing the extent of diagnosticity, the extent of overreaction of beliefs in the model to match covariance patterns we see in exactly the microdata I started with. So not only firm financials and their links to one another, but also their link to future disaggregated forecast errors. And that's going to help us pin down and estimate, and this quantitative exercise, meaningful departure of beliefs from national benchmark to match the types of forecast overreaction we see in the data. So then once we've gone through these first 3 steps, the fourth part of the paper, we've kind of mechanically put a model out and some facts and ground through a structural estimation. In the fourth part of the paper, after eating our vegetables, we get to eat dessert. Okay? And conceptually, the nature of our analysis here is not to say, let's look at a bunch of macro data and cook up a model to match a particular set of macro facts. The nature of our exercise will be, let's take a canonical model with a belief system that matches micro belief facts, then aggregate it and see what we get at the macro level. And that's what we can analyze in this fourth step. And what we uncover in this untargeted exercise is a range of patterns that look like realistic credit cycles, quote unquote. Basically, we get meaningful macro financial reversals that kind of tie into a scenario in which during good times, over-optimistic firms enabled by over-optimistic lenders expand their investment and debt issuance to high levels that is subject to quick reversals in some sort of very distinct and predictable credit cycle pattern. So we link to that macro finance credit cycles literature. We also, and this is of more interest to people that are like me, obsessed with firm investment for its own sake, this type of belief system is also going to generate meaningful investment nonlinearities or state dependence, in which the economy becomes much more responsive to adverse shocks during good times than it is during bad times. Because during those good times, over-optimistic firms have overextended themselves and been enabled to do so by loose credit pricing. Okay, we get investment state dependence or pro-cyclical responsiveness of investment to shocks along a focus and feature of the investment literature. Okay, so this is what the paper does. If we get cut off again via Zoom, that's fine. You've seen what we've done just here, but let's actually take you through the mechanics. And in particular, let's talk a little bit about the data. The data source, as I mentioned, covers some US public firms. These are standard sources of information. We're going to be extracting profit forecasts made by firms themselves in the IBIS guidance data set. How does this work? Well, in a given fiscal year, a firm's releasing its financials. So in year T, they're saying, here's our financials, and they're also making predictions about their own profits publicly in year T+1. It's the guidance data we have. We're also collecting standard financials from CompuStat and using the words bond return database to get information on the bulk of the corporate bond market at issuance and secondary market levels. So what we're going to do first with this data is just formalize the overreaction patterns that I started with in the first figure. So this is a set of panel regressions. They're quite simple, identifying off of purely idiosyncratic within firm variation, linking as the outcome in each column forecast errors for a firm in year T+1, so profits minus the firm's forecast from the previous year, linking that and testing its association with the range of outcomes in year T for a firm. So whether we measure good times for a firm as being a time when a firm is issuing a high level of profit forecast, when they're earning high profits, when they're investing a lot or issuing a lot of debt, systematically these negative associations are telling us the same thing we saw visually earlier, that during systematically good times, firms are more likely to be over-optimistic, more likely to be disappointed in future, vice versa during bad times. In the paper, we spend a great deal of time also linking these types of predictable reversals and outcomes relative to beliefs to credit market and real outcomes at firms, and showing that those reversals are linked to bond returns and investment outcomes. But let me go ahead and shift gears and say, now that we have some facts about disaggregated forecast overreaction on the table, I need to tell you a little bit about the model we're using to interpret some of this. And although the model is quite rich, much of the model, the heterogeneous firm's macro financial structure, is quite standard. So I'm going to spend a fair amount of time telling you about the beliefs, our single innovation in this modeling context, and then I'll kind of briefly overview the other more standard elements of the model. So what's the belief system that decision makers in this model are going to be endowed with? Well, I mentioned it's diagnostic beliefs. So this is a particular formalization or micro-founding of an old idea from behavioral finance that agents are going to be subject to some sort of representative bias, or in a simpler level, just be likely to overweigh states of the world that have high likelihood relative to some reference distribution. In our particular context, what we're going to be thinking about, this is an intertemporal context, is decision makers forming beliefs about some outcome xt+1 in period t+1 after observing xt today. And their beliefs, this F theta distribution, are going to be proportional to or depend upon the rational beliefs. There's going to be some sort of kernel of truth here, but their beliefs are also going to be distorted in two states of the world that are more likely tomorrow, in light of what I observed today, relative to what I would have predicted, and this is the reference distribution here, relative to what I would have predicted yesterday. So to the extent that this parameter here in this relative likelihood term, theta is greater than 0, we get diagnosticity or departures from the rational belief system that overweight these relatively likely states of the world. Okay, so that relative likelihood formula can be a bit abstract. Let's be very concrete about what this does in our particular application, which is, so we're working with a very standard business cycle structure here, a world where agents are forecasting log TFP processes at the aggregated and disaggregated levels. So in that context, this X, this log TFP is going to be a Gaussian AR1, and beliefs of diagnostic decision makers, expectations with this funny theta index on them about tomorrow's outcome are going to be equal to the rational beliefs, plus a term that adjusts beliefs in the direction of recent news or recent changes in expectation. That adjustment occurs to a degree that's mediated by this diagnosticity parameter theta, where greater than 0 gives us this overreaction and equal to 0 recovers that rational structure. Okay, so this is the belief system that we're endowing agents in this model with. What's the standard stuff? Well, the standard stuff is rich. There are a range of moving pieces, but it is canonical. So I'm not going to spend as much time on these individual pieces, but I want to emphasize that at the real side, we have a rich distribution of firm heterogeneity, a continuum of firms hit with their own persistent TFP shocks, together with a macro driving TFP shock process. They're decreasing returns in production. I do care who produces what. And firms are making investment choices subject to time to build and adjustment costs. So these firms are financing themselves partially through risky debt. That debt faces some sort of endogenous price schedule. These firms can choose to default on that debt. They can also finance themselves with some costly equity issuance here. That debt is priced by lenders who understand the possibility of default and that it depends upon debt issuance and the other states at the firm level. They'll take these default likelihoods and recovery rates into account to price this debt. Both firms and lenders are subject to diagnosticity in their beliefs in this context. And we're knowing everyone with that belief system. I'll show you some results in partial equilibrium, but the paper endogenizes prices and goes through our similar conclusions in that case. So what does diagnosticity manifest itself as? Well, I'm going to give you a brief window into that by just showing you some slices of perceived firm value functions. Okay. So on the horizontal axis, I have a measure of idiosyncratic or firm level capital, and I've got perceived firm value on the vertical axis where I'm fixing the levels of aggregate and idiosyncratic TFP today, as well as debt at the firm level. And in the rational model, with rational expectations or perceived firm value is this black line here, given that all the productivity processes are first order Markov chains, as long as you know today's level of the productivity, that's all you need to conclude what your firm value is. And there's only a single value function that I'm plotting. By contrast, under diagnosticity, that's not the only state that matters, because you don't just care about today's productivity, how you got there, what the recent news, which influences your over-optimism or pessimism in this model, also matters. And so the green, blue, and red lines are otherwise exactly the same states, but for diagnostic firms that got to today's productivity with good news, neutral news, or bad news. And we see that that influences, through the diagnostic belief structure, their perceived firm value. This type of ordering also, as you would imagine, shows up in their investment and debt issuance choices and things of that nature. Okay, so that's a little window of how this actually works at the disaggregated level. We've got a model in place. What do I want to do with the model? Well, I want to show you results from the model, but I want to plug numbers into it first. Okay, so how do we quantify this thing? Well, we're going to structurally estimate this model with kind of a rich SMM procedure, where what we're going to be doing is estimating the model's parameters by targeting 18 combined micro and macro moments. Okay, so at the micro level, we're going to target the covariance matrix of standard financials like profits, investment, debt issuance, and credit spread data for individual firms. Crucially, not only interested in disciplining classic firm fundamental and financial parameters by looking at those covariances, but also disciplining a crucial beliefs parameter, this theta object, the extent of diagnosticity or extrapolation, disciplining that parameter in this SMM procedure by matching the link between firm fundamentals at the micro level and future forecast errors. Okay? And because this predictability that we saw systematically to start with is consistent with meaningful departures from rational expectations, we're going to get in our estimated model a value of theta, this beliefs parameter, that's meaningfully different from 0, somewhere around 1, kind of in the ballpark of estimates of the same parameter from related models, kind of giving us some confidence in these results. We're going to have not only that estimated diagnostic model in hand, but we're going to compare as a benchmark the behavior of that model to understand the impact of beliefs to a model that is constrained to have theta equals 0 irrational beliefs, but is estimated in an otherwise identical fashion. Okay, so we've got these two laboratories to work with here. And at this point, we're then going to be able to ask a simple question. Okay, now, and once again, I'll walk through the conceptual logic of our exercise here, because the conceptual logic of our exercise is not to target or to generate a particular set of macro facts or to claim that we can match all of the macro financial facts out there, but instead to say, what do we get from this very constrained procedure? Matching only disaggregated forecast overreaction patterns with this diagnostic belief structure, what do we get when we simulate the macro behavior that comes from such a model? Okay, and how does that differ from a model that can't match overreaction? So what we do in the paper is systematically step through a range of kind of untargeted, but turns out to be quite realistic macro financial behavior that emerges from this exercise. And at its core, we're calling these kind of realistic credit cycles. Basically, all of the patterns are generated by something like the same underlying intuition, which is that good times with recent good news generate over-optimism, given diagnosticity, both on the part of firms issuing debt and investment, but also on the part of lenders that are going to be loosening credit prices and enabling firms to build up investment and debt. And that type of over-optimism is naturally subject to quick reversals that can manifest themselves in something that looks like a credit cycle. Okay, so in particular, what do we actually get more precisely? Well, we get some stuff that isn't even necessarily in the credit cycle space. We just get more macro financial volatility as well. We also get countercyclicality in credit spreads very naturally from diagnosticity, because we have kind of sharp supply movements in credit as well. We're going to get strong nonlinearity of investment. And as a person who's been thinking about investment nonlinearities for a large part of my career outside of a belief space, this is a quite attractive generated phenomenon from this belief structure. We're going to find that firms during good times that are over-optimistic and have issued a lot of credit subject to loose credit pricing are quite vulnerable during those good times to adverse shocks. And we see big swings in aggregate investment at the top of the cycle, much sharper than we would at the bottom of the cycle. So we get pro-cyclical investment state dependence. We also, from the same type of reversal mechanism, are going to be able to do things like match credit spread dynamics during the Great Recession for very small TFP shocks that come after boom times. And then we can generate recurrent kind of predictable reversals in some asset prices and credit quantities that have often been an object of interest in this macro finance empirical literature on credit cycles. So, at this point, I'm just kind of listing things that we do with this mechanism, and the paper goes into all of these. But given that investment is so near and dear to my heart, I'm going to just show you what this investment nonlinearity looks like. In particular, I'm going to show you an impulse response of aggregate investment to an 1 standard deviation negative TFP shock in normal times. That's the shock that's on the left panel, and it's the same in the diagnostic model in red, the rational model in blue. What we see as the investment response on the right is, well, investment declines. It's a persistent negative shock. Phew, that makes sense. But we actually don't see a tremendous amount of difference between the two paths. We get a little bit of amplification and reversal in the diagnostic model, but they're kind of qualitatively similar during the normal or averaged impulse responses. But that picture changes dramatically when we think about the investment response starting from different initial conditions. And so this picture is, on the vertical axis, showing us the on-impact initial period response of aggregate investment to a 1 standard deviation negative TFP shock in the diagnostic in red and rational models in blue. as a function on the horizontal axis of the previous period's TFP shock. So normal times, average times, I would have had a neutral previous TFP shock been at 0, and the vertical axis just plots out those on impact points in the impulse response function, which are similar across the two models. By contrast, when we think about what happens when we see a negative shock after good times, moving to the right in this graph, in the diagnostic model in red, we're seeing a much sharper negative response of investment to the adverse shock. We're seeing reversals, basically, as over-optimistic firms that have been enabled to be over-optimistic and invest a lot and issue a lot of debt with loose credit pricing reverse themselves. And that type of nonlinearity, the negative slope with initial conditions or state dependence in the diagnostic model, is largely absent in the rational model, where we have something like a more flat investment response across different points in the cycle. Okay, so we get meaningful state dependence. For those of you who care a lot about...
You're down to 1 minute.
Yeah, absolutely. It's perfect. So for those of you who care a lot about credit supply and credit demand here, we're able to decompose this type of nonlinearity into a credit demand and supply channel by considering a world where we're not comparing just an everyone's rational model to an everyone's diagnostic model, but in this green line, considering a model where firms are diagnostic or overreactive, but credit prices are rational. And in that case, we're going to see that although nonlinearity is not eliminated, a meaningful portion of it is. And so there's an important role in this model to be played by both the demand and supply sides of the credit market and thinking about macro nonlinearity. Okay, so what have we done here? Since I need to conclude, we've shown you forecast overreaction in the micro data. We've built a canonical macro financial heterogeneous firm's business cycle structure that can match that with diagnosticity. When I take that to that micro data and see what I get at the macro level, we get realistic reversals in credit cycles. Okay, so thanks so much.
All right, thanks a lot, Stephen. And the discussant is Hanno Lustig. Hanno, are you there? Yes.
We could see your screen, Hanno.
Yeah, I was sorry about that. I was trying to figure out how to. You'd think that after a year I would know how to unmute myself when I started sharing, but I couldn't figure it out, so I had to go back. Okay.
You're not the only one.
Yeah. All right. Wonderful world of Zoom. Okay. Well, thanks a lot for inviting me to discuss what really is a very ambitious paper. I had a lot of fun digging into this. Obviously, this is a little bit outside of my area, so maybe my perspective will be that of an outsider, but hopefully you'll find it useful. So let me start by putting this paper in the context of the literature as I see it. So there's a growing literature on corporate credit cycles. People have observed that there's a strong connection between corporate credit markets and economic activity, and what you tend to see is these sort of boom-bust episodes. And there's a ton of recent interesting work that documents these episodes. What this paper does is it is going to argue that really expectations, beliefs, and mistakes, systematic mistakes, play a key role when you're trying to understand these credit cycles. And in particular, what's going to happen, and the authors use an otherwise fairly standard neoclassical business cycle model to make this point. What's going to happen in the model is that there's sort of over-optimism in a credit boom. After positive news, investors forecast fundamentals that are too high, defaults that are too low, and managers make similar mistakes. That's sort of the key driving force. At the empirical level, this paper makes contact with this growing literature in macro that I just mentioned, and just to give you one example of this. So what macroeconomists have focused on over the past couple of years is this notion that corporate credit spreads are very good predictors of future economic activity. For example, there's a highly cited paper by Gilchrist and Zakrzewski that computes something called what they call the excess bond risk premium. So they just look at spreads on corporate bonds, but they remove the part of those spreads that can be directly attributed to variation in actual default rates. They call this the excess bond risk premium. And they show that that particular excess bond risk premium, the red line in that graph you're looking at, so what's left after compensating for default risk per se, that's very predictive of future economic activity. And macroeconomists have sort of concluded from this evidence that what we need in models is sort of a financial shock. And I interpret this paper as sort of reinterpreting what that excess bond risk premium is really capturing. And I'll come back to that in a second. So in terms of the broader literature, I think there's sort of three different ways of thinking about what's going on here. One is just sort of your standard risk premium channel. When you hit a recession, the standard investor becomes more risk averse for whatever reason. Maybe she has external habit preferences and risk premium increase. That's sort of one view of what's going on. A separate view, second view, is that there's a particular role to be played by the intermediary sector. The banking sector, or more broadly defined, financial intermediaries have limited risk-bearing capacity, and when that capacity is impaired or reaches its limit, lots of things have to adjust, and that sort of is a channel that's of course explored in the seminal paper by Hay and Krishnamurthy, but more recently there's a bunch of work on this channel that's actually directly related to this paper. I'll come back to this second. There's recent paper by Arvind together with Wenhao Lee that explores this channel, but also allows for non-rational beliefs. And there's a very nice paper by Peter Maxted, who was on the job market this year, that does something similar. So that brings me to the third channel, which is where I put this paper, where you're really exploiting mispricing with extrapolative beliefs or non-rational beliefs. This paper fits into this. This paper explores that mechanism in an otherwise fairly standard model. So that's how it's different from the paper by Arvind and Wenhao and Peter's paper, because in those papers, there's a particular role to be played by the financial intermediary sector. Okay, so that's how we put the paper in the context of the literature. So looking at the mechanism, the key equation is obviously this one. Diagnostic expectations are given by your standard rational expectations plus this sort of adjustment term that's governed by theta. Theta is going to be a positive number. And basically what you're doing is when you're seeing good news, when the macro releases are better than what you'd expected, you're going to overweight high, good future states of the world. What's going on in the background is that you're distorting the densities. You're putting more weights on states that today see a large increase in the conditional probability. Okay, that's really what's driving this. So in that sense, I think this paper sort of fits into a broader literature that, for example, people like Hansen and Sargent have contributed to, where they're considering departures from rational beliefs and belief distortions. In their agenda, what they try to do is sort of use statistical tools to measure and discipline the size of these distortions. And they sort of try to look at distortions that are fairly small, so that models couldn't easily be told apart by an econometrician. The authors of the current paper obviously come at this from a different behavioral angle, but ultimately I think it's a similar agenda. It would be nice to sort of help me understand what a theta of 1, which is going to turn out to be sort of the number we're going to use, what that sort of really means. And maybe the statistical machinery that Hansen and Sargent developed could help us sort of understand what that number that number means. I think that would be an interesting thing to do. Let's take a look at stock prices to sort of explore what diagnostic expectations do. So suppose that dividend growth follows an AR1 process, and I'm going to give the representative investor diagnostic expectations. I think that's going to help us understand how this channel works. So what this means is that your expectation of future dividend growth is going to be given by the sort of standard rational expectations component governed by phi1 to the j, where phi1 is that A1 parameter. But then you're also going to have this new component, which captures the extrapolative component. If you see good news, your forecasts of future dividend growth well into the future are also going to be off. What's interesting is to then sort of think about, well, what does that imply for valuations? Because really the way I think about this paper is it's exploring sort of a mispricing, misvaluation channel. And so it's interesting to sort of understand, well, how is this going to affect the price dividend ratio? Well, you can go back and sort of do your standard Campbell-Schiller decomposition. But of course, what we're going to do now is plug in these diagnostic expectations for the cash flow term. There's nothing much going on to the discount rate term. I'm just going to assume, which is in line with the way the authors approach this, that expected returns are constant under the subjective measure. And so what you get then is an expression for the price dividend ratio that has sort of the first standard component governed by phi1 times dividend growth today, plus this extrapolative component that is governed by theta. What this tells you is that in response to positive macro news releases, you're going to see an uptick in the price dividend ratio and lower future returns. This is obviously happening because agents make a mistake in forecasting future fundamentals. The size of this effect is going to be governed by phi, right? So you really need large persistence to begin with in order for this to have a big effect on the price dividend ratio. Again, under the subjective measure here in this example, agents expect constant returns. Now, it turns out there's some really encouraging evidence that this might be a good way of thinking about stock price variation. There's a recent paper by Ricardo Delao and Sean Myers that just came out in Journal of Finance, where they do exactly this. They do a subjective Campbell-Schiller decomposition by using forecasts for earnings growth backed out of surveys. And they do the same thing for the discount rate component. And they actually show that between 60 and 90% of the variation in the price dividend ratio can be imputed to that blue stuff, to the subjective cash flow component. So this seems like a particularly promising and potentially potent channel for understanding variation in valuations in stock markets, and potentially also in bond markets, which I'll talk about in a second. Of course, if you're an econometrician and you're doing this decomposition, then what you would do is you would sort of call this diagnostic component the discount rate component, because that's how it would show up in your regressions. What's really going on, of course, is that the positive cash flow news leads to lower expected returns under the objective measure. That is to say, lower expected returns as picked up by the econometrician. So in the background here, we're sort of relabeling the traditional discount rate component and sort of really imputing it to mistakes investors make when they're forecasting cash flow news. This consists with evidence from an older paper by Greenwood and Shleifer, which shows that expected returns actually don't really move in the right direction if you measure them from surveys to explain price dividend ratio variation. Now, you're probably thinking, why the hell is he talking about stocks? This paper is about bonds. Well, I think the same thing applies to corporate bonds. Suppose that we write down a process for productivity growth that is sort of very persistent, and suppose that the coupon payments on a corporate bond portfolio depend on, obviously simplifying a lot here, in a linear way on the level of productivity. we can sort of do your standard Campbell-Schiller decomposition again. Obviously, if this was a paper about treasuries, then there would be no cash flow component, but because these are corporate bonds, there's a cash flow component. You can back out the yield on the corporate bond portfolio. And what you see is that when there's positive news, a positive macro release, you'll get yields that are going to be lower, and you're going to get higher contemporaneous returns on the bonds and lower future returns, again, because of that forecasting mistake. So if you sort of put on your econometrician hat and you look at what's going on here, you again have sort of your standard cash flow component for the yields on a corporate bond portfolio. But now, in addition, what the authors do is they're adding a discount rate component that's really unrelated to future defaults. And in some sense, that's sort of exactly the excess bond risk premium, in my view, that Gilchrist and Zakrajsek are looking at. But here it's driven by extrapolation of cash flow news. So that's kind of, I think, a good way of thinking about what the authors are doing. So if you go back to, say, Gilchrist et al., and you look at, for example, what happened in 2008, 2009 from the perspective of the excess bond risk premium, you could sort of say, well, the Y, the corporate yields, has your standard rational cash flow component, but now there's this sort of a new component driven by extrapolation. And so in some sense, you could say, well, the great financial crisis now is really the great forecast error, right? What's driving it is that in 2008, 2009, there was a big negative U realization. And as a result of that, investors were too pessimistic and corporate spreads became much too high. That's what's going on. What I'd like to see here, if that's possible, and I don't know if it is, this is kind of a question for the authors, is can we do something along the lines of what Ricardo and Sean did for stocks? Can we sort of plug in survey expectations for future defaults and then do a subjective Campbell-Schiller style decomposition of corporate bond spreads? What you really should see then, if you do this, is that subjective variation in expected defaults should explain most of the variation in corporate bond yields, and this subjective variation should be driven by these surprises, right? That is to say, I'd like to see direct evidence that GDP forecast errors, or the equivalent of that, would be driving variation in something like the excess bond risk premium. There's some related evidence in a separate paper that three of these authors have, Bordalo and Shleifer, that there's predictable errors in forecasts of credit spreads, but I don't think it directly speaks to what's going on in this paper. Okay, let me conclude by offering a few comments. So I think the micro evidence, the firm level evidence that the authors start out by showing is very compelling. They show that the large negative forecast errors by managers at the firm level reliably predict increases in firm level bond yields, lower contemporaneous bond returns, lower firm level investment, which I think is compelling. I don't think it directly speaks to the mechanism that's operating at the macro level. For one thing, macrodynamics are very different from microdynamics. So I was hoping that maybe we could have some evidence that directly speaks to the macrodynamics as well. And then I have a couple of sort of more nerdy questions when I was wrestling with the paper that I was thinking about. So in the partial equilibrium exercise, what you do is you have these probabilities of idiosyncratic and aggregate states of the world at the firm level that are separately distorted. So each process is sort of separately distorted with the same theta parameter. And I was wondering, was that a general result when we sort of assume agents have these diagnostic beliefs? Does it follow that we can do this, that we can sort of separately think about aggregate and idiosyncratic risk and apply that first formula for diagnostic expectations that I showed you? It'd be nice to give the reader a bit more guidance there, especially if we want the broader macrofinance community to work with these expectations in this class of models. That brings me to my second point, thinking about general equilibrium. there is a small part of the paper that actually sort of does some general equilibrium by endogenizing wages. The state space now, of course, is sort of this huge, large dimensional object. You have to measure the cross-sectional distribution of states, capital, and debt. So you have your typical cursive dimensionality problem. The way the authors deal with this, which I think is quite creative, is agents are going to use the truncated history of aggregate shocks in order to make forecasts about prices. Here, I could have used more guidance. How does diagnostic expectations exactly work here? It felt to me like we were sort of sliding slowly back to rational expectations in a way here, even though the other authors in previous work carefully point out that this is not just the perturbation of rational expectations. So I think it'd be nice here to provide more guidance on how exactly diagnostic expectations work when you have this problem that agents face where they have to make forecasts about future market clearing prices, which I think is not an easy thing to wrap your head around in this context. So that would be, I think, useful going forward to talk a little bit more about. And then the last question I had is sort of why is it that we can just sort of assume that investors and managers distort probabilities of states in exactly the same way? That wasn't quite clear to me as well. The last thing I want to say, and then I'm going to conclude, is that, of course, and this sort of goes back to the slide I showed you at the beginning, an obvious concern one might have, this idea of credit cycles, is that, of course, it could be that credit markets are just really responding to macro shocks. And there's actually a very nice, interesting paper, new working paper by Bones, Sotonello, and Volkanov that sort of tries to argue that at least part of the action we see in credit markets is perhaps just in response to macro shocks. So what they do quite cleverly, I think, is they exploit exogenous macro shocks. For example, they use Ramey's fiscal shocks, start of the Vietnam War, start of the Korean War, plausibly exogenous. And then they show that these exogenous increases in GDP lead to significantly lower credit spreads. So you can sort of be fairly confident that they get the direction of causality, right? I wouldn't say this is inconsistent with what's going on in this paper, because in this paper, it's also fundamentally macro shocks that are driving the expectational mistakes. Credit markets are also responding, but they're responding to the macro forecast errors. But certainly, the authors of this paper see this evidence of more supportive of standard countercyclical risk premium story. So that's the last point that I wanted to make before I conclude. As I said, I learned a lot from reading this paper, learned about this literature. What the paper does is it sort of proposes a new business cycle propagation channel. As the author said, they come bearing just one free parameter, theta, and they get a lot of action and mileage out of it. It delivers a new mispricing mechanism in credit markets due to these diagnostic expectations. And in the process, and this is sort of perhaps my idiosyncratic asset pricer perspective, what you're really doing is sort of relabeling what we traditionally call the discount rate component and making it sort of a subjective cash flow component, because agents are making these mistakes in forecasting future cash flows. Let me stop right there and stop sharing my screen.
All right, thanks a lot, Hanno, for the discussion. And as before, the usual rules, audience can ask questions. If you want Stephen to directly respond to one of Hanno's comments, then you can reiterate his question. Otherwise, it's open now for questions.
Hi, may I ask a question? Can you hear me?
Yes.
Yeah, very good. I would like you, if possible, to go back to the very last slide, in which you were showing the immediate response of investment with respect to the different questions?
Sure.
I probably, it's a little bit late. I probably got confused. It's just a clarifying question. Number one, was that showing the response of aggregate?
Something like this?
Yep.
Okay, yep.
So
yeah, and the answer is yes. So these
Okay.
are aggregate investment responses to an aggregate innovation in TFP.
And just to be clear, this is always with respect to a negative realization of the
Correct. Yeah.
So just understand, I understand that the hybrid version of the model, which you have rational expectations of the household, but different expectations on the firms, the problem is not so evident. But how do you feel about the investment movement when you are at the bottom?
Yeah, absolutely. So it's a good question. So what's
Yeah.
going on like at the far left with diagnosticity? So in this kind of model, what's happening when we see this type of very adverse shock to TFP in the period before today's negative shock is that basically a really bad negative shock yesterday makes you very pessimistic, and just one standard deviation shock today is actually good news. So under diagnosticity, this line can actually cross zero, and that's what's going on there. It's not magic in this case.
And that's great, but do we have empirical guidance about this? Because
So we
this
have a
sounds
lot
like
of
a discriminating.
So we have a lot of empirical evidence on investment state dependence, broadly defined, which is just a slope of investment responsiveness that is larger to the right. Okay, so in that sense, we're kind of consistent with it. The exact magnitudes of this investment response, and this is something we actually highlight in the paper, not the qualitative distinction in the shapes, but the exact magnitudes do depend on whether it's partial or general equilibrium. So we've known for a very long time in this class of heterogeneous firms models with an investment focus that the exact nature of SDF movements and price movements can kind of strongly dampen investment fluctuations. And so what you see in a version of our model with price movements is that although the nonlinearity survives meaningfully in general equilibrium, the actual magnitudes and the nature of these big crossings we see far to the left, those are substantially dampened. So what I care about and what I extract from diagnosticity is the nonlinearity rather than the exact magnitudes for PE.
Okay, fair enough. Thank you.
Thank you.
I have a question for Stephen.
Great.
Interesting paper. I'm wondering if there's costs to being wrong. And I was just wondering if you allow agents to, ones that are say more correct on average, to benefit from that. And then what happens to the agents who are not so correct in the long run? Do they survive?
Yeah, it's a good question. So whenever you write down one of these models with the behavioral departure in it, it's nice to spend a bit of time kind of stepping back and kind of thinking about like the evolutionary dynamics if you have coexistence of agents in this case. So here, although that's not the main focus of the paper, we do think, I have thought carefully about that. And actually what turns out to be the case is that a rational value maximizing agent turns out to have less volatile beliefs. Okay, in this model, because overreaction gives you beliefs that are moving around all over the place. And there's an option value to staying in and exiting the model that's very prominent in this model of default. And what you end up with actually is, on average, lower default for the diagnostic firms. And so even if it's not value maximizing, you actually see more survival over time of these distorted decision makers than you would in a rational model. So we don't focus on cases in the paper where there is coexistence, but because of that distinction in average default rates, you would expect a slow growth of the fraction of diagnostic agents over time if you were to go down that road, just because of the fact that value maximization and a rational structure isn't equivalent necessarily to longer survival here.
Okay, and that has nothing to do with Hanno's comment about exogenous sort of asset positions, or like the allowed trading of the rational agents and the other ones. Would that affect it?
So there's an important question about the extent to which an assumption of homogeneous distortions in beliefs across agents in our model is responsible for the dynamics we uncover relative to at least two alternatives. And so in the very nice discussion, we saw highlighting one alternative, which is thinking carefully about an interesting case, which is potential differences in belief distortions across firms and lenders, for example. We know, from the macro finance literature broadly, there's a lot of cool work on belief heterogeneity that's even more disaggregated than that. We have thought about this, okay, although our perspective and the philosophy of what we're doing is that this is a psychological thing that applies to humans in general, and it's not in line with our philosophical exercise to start sprinkling heterogeneity across agents in that way, but we have thought about it a bit. And that's what I was showing at the very end with the decomposition of this investment nonlinearity graph into full distinctions between everybody diagnostic and everybody rational, and a world where only firms are diagnostic, but these, perhaps some big credit lending institution is rational. And you see that that matters, okay? And so I do want to encourage that line of inquiry, because that type of heterogeneity does lead to lower nonlinearities in investment. And so there does appear to be a meaningful role in the phenomenon we're finding that comes from extrapolative beliefs on the part of different agents. And so I'm very sympathetic to that being an interesting line of discussion, but that's about as far as I can go based on the current paper's results.
Thank you. Thank you.
Thank you.
Let me just follow up on that and kind of more generally, I think, on Hanno's comment about
Sure.
who is irrational, all right? And I guess in your benchmark, everybody is diagnostic, right? It's kind of
correct.
A rep agent, in which case this discussion kind of is moot. But when we're taking this to data, this starts mattering, and I think heterogeneity starts mattering. And we already had this discussion earlier in the first paper with Eduardo about, well, why is it necessarily that lenders, in his case, maybe lenders may be more optimistic than equity holders, or vice versa. In your case, you could say, well, it's the managers are more overreacting, effectively more diagnostic, let's say, than creditors. That's a plausible, I think, scenario given the evidence that you have, right? Because you're using managers' forecasts, and then if we use it, right, for kind of your estimate of
correct, yep.
Because it's not clear how we measure creditors' expectations, but at least we do have forecasts of default rates, right, from Moody's, S&P, and so on and so forth, and fairly detailed data in principle on time, expected default, and so on, which I think will, if you use those, and I guess again that goes back to Hanno's question about, well, how do we discipline these belief distortions with data? This is not the same thing as earnings estimates, right? Necessarily of IBIS forecasters, although in principle you could use those two potentially to get a sense of what maybe investors' estimates are. But to the extent that we have Moody's or S&P forecasts of defaults, unlikely they move enough to explain these huge swings in spread. Certainly things like the financial crisis. I think that financial crisis would not look like a forecasting error by Moody's. If anything, I think they probably reacted too slowly rather than, but I'm not sure. Right? Would it look like a forecasting error by managers? I don't know. But so the question is, does this heterogeneity in diagnosticity, I guess, matter? And whether, well, it doesn't matter who is more diagnostic. And I guess again, my comment earlier applies. If we have different types of investors, some are more diagnostic than others, let's say, will they kind of sort themselves into those who will hold debt and versus equity in different time, different periods, depending on recent history, and so on. And generally, how do we think about it in a world where there are different asset classes that are all exposed fundamentally to the same shocks? I mean, debt and equity, right? And then there's this manager who also might be and in fact, in your setting, is diagnostic and is choosing not just investment, but also how much to borrow, how much equity to issue, and all of that. I don't know.
Yeah. So let me let me summarize the question. We're just going to start to attack that because there's a lot of richness there, but just kind of getting at this question, which I can answer as part of this, which is, does it matter? And the answer is, it does. Okay, so for us, we are making the following assumption in the model, which is that everyone has the same belief distortions. And exactly as you are correctly highlighting, we're disciplining everybody's extent of overreaction with evidence on overreaction from manager forecasts of their profits. Okay, and so what I can say is that when you take away the uniformity, the extrapolation that we're doing between manager overreaction to creditors in the model, when you take that away and have just diagnostic managers and rational lenders, one polar opposite, probably not the full plausible corner to go to, but we do see a reduction of about half of the nonlinearities that we're kind of highlighting here. So it does matter. So the question is whether with my data right now, I'm in a position to tell you where exactly on a curve from 0 to even greater diagnosticity on the part of creditors relative to managers, we lie. And I like the suggestions that you've made here for potential places to go to look for discipline on that. But because I haven't used those sources of variation to discipline any heterogeneity in beliefs, I can't really tell you what's the most plausible case. I would also make one more comment. Okay, in addition to just generally registering sympathy with the question, I would make one more comment, which is that to really do this well, I would want a richer model of creditors than what right now is basically a no arbitrage condition in the background alone. Okay, and so to really take this seriously, and I think that's interesting, I would want not only good data on creditors that could be disciplined in some way, but also a slightly richer and differently designed model for different purposes.
Can I also ask a question?
Of course.
I mean, maybe this is going back to Colin's question a moment ago, but I mean, if you have heterogeneity in beliefs, actually in your model, then there's a little bit of maybe pressure to create new assets so that you allow these people to take bets, take opposite positions, because they know, I mean, at least if they understand, they have different beliefs. So it's a little bit like if you introduce heterogeneity, then the asset structure maybe should also change to the extent that the people would want to engage in these new assets. And the one worry might be that, well, okay, then the people who have more distorted beliefs will end up losing money systematically, and sort of like what Colin said. And but of course, you could have restrictions on that. So you'd like to go short to make money, and you're very rational, and everybody else isn't. But maybe there are restrictions against going short. So, but the point is somehow that if everybody's the same, the need for these gambling opportunities in the form of richer contracts are not there so much. Once you introduce heterogeneity, there will be like a need. People will, I mean, in fact, it may well be that the very richest people we see are people who actually are going against everybody else's. I don't know. I'm just. So I think this fits into the genre. I mean, it's a question that has to be asked at the same time. So it's kind of a mix of these different questions.
Got it. So thanks. So this is true. If you have heterogeneity in beliefs, there can be non-trivial interaction across these agents. There can be pressure for new assets. There can be interesting interplay between these agents' financial positions. We also know that heterogeneity in beliefs is broadly interesting in thinking about macro financial fluctuations and leverage from a rich pre-existing literature in macro finance. So I'm very sympathetic to that. One thing that I think is useful that we bring to the table, potentially disciplining, or potentially might be useful to discipline a model with such heterogeneity, even though that is not the goal of the current paper, is a lot of work that we do to empirically invest forecast overreaction across different groups of firms. So although I don't have data on creditors, for example, and I'm just looking at managers of US public firms, when you look at, for example, big US public firms that are large or old or investment grade versus high yield, what you systematically see is forecast overreaction across these different subgroups that we've looked at, observable subgroups. And in particular, the thing that's really pinning down theta equals 1, the degree of diagnosticity that we're endowing people with, is forecast errors tomorrow that are something like proportional to the size of innovations today. And that pattern is quite robust across the observable bins we've looked at. And I think that fact would be something useful as an input into an interesting other paper that really tries to attack this heterogeneity, which I agree matters.
I'm not sure if there is extra time, Nick. I have just a follow-up with. So here is what, okay, on the one hand, I understand that given the origin of your forecast data, you want to be very focused on the behavior of firms. And so the non-linearity of the responsible investment is a key slide that you gave in this way. Okay, that's okay. But maybe this is what I couldn't understand. What would happen investment and non-linearity where all of a sudden just get about leverage, and so stop talking about the credit channel?
I apologize. I think you cut out at a key moment, and I didn't get all of that
what
last
would
sentence.
happen in this model where you study the non-linear response of investment in the extreme case in which there is no financial leverage? So you forget about the credit cycles and you just try to explain that non-linear investment through the behavior of managers, regardless of how they finance them.
Yeah. So this is useful, and I think it gives me a little bit of a chance to talk about what's needed to get nonlinearities and reversals from our belief system. So the belief system in the background is a symmetric belief system with both over-optimism and over-pessimism in response to shocks. That doesn't necessarily sound like it would be something that would generate nonlinearities, just kind of excess volatility initially. So the key interplay that we get that generates nonlinearity for us is the interplay of these overreactive beliefs with financial frictions that have this kind of one-sided default threshold. And that's what kind of gives us this over-optimism with reversals. In interesting work that has been done and kind of thinking about the consequences of belief distortions in models that don't have that sharp nonlinear financial friction component that generates the asymmetry, which we are loading on and which does matter for us. Work by people like Jose Maria Barrero, for example, in his very cool job market paper, shows that you can still get really cool results from the perspective of a firm heterogeneity guy like me in things like misallocation and aggregate TFP and steady state from this belief distortion, but they no longer have the same asymmetric flavor. Okay, and so things do change, but there's still cool stuff. Is the kind of the core summary response. I also want to just take like 10 seconds and thank you so much for a very careful discussion. I learned a lot from it. I appreciate it.
I know we're in overtime, but we're in the world where nobody's rushing to catch a plane. So to the extent that there's good discussion to be had, I don't want to cut it off. But I think that's, if this is it, maybe I'll use my right of a residual claimant, I guess, and conclude. I think this exchange. I think what you said is that the nonlinearity is reduced if the creditors are less diagnostic, right? So I think that going back to Per's point, right? If we have some really deep-pocketed and smart guys, there is Howard Marks sitting there on billions of dollars of dry powder, waiting for everybody else to go crazy and sell their bonds, and he will go and buy them, and that will kind of reduce the nonlinearity of that effect on investment. But I guess in your case, because the manager is still overreacting to the recent things, the Howard Marks may make more money, but that's not necessarily going to completely alleviate the dislocation in real investment, right? Because it's the managers who are ultimately doing that investment, and they're the ones who are overreacting, and not the financiers. The financiers are ready to give them capital.
Well, can I just say, I mean, I think also you should allow the possibility that new owners would kick out the management. I mean, or get involved in investment decisions potentially, at least to the extent they depend on macro events that these truly super smart people have a good handle on. So I think that that it's part of the whole thing. I'm not saying that there's nothing to this paper at all. I just think critical thinking would push a bit in this direction too.
I mean, that adds another layer to this, right? Because
Yeah.
that's exactly what guys like Howard Marks do ultimately. If the company is in distress, they get the seat on the board, and if they think the managers are idiots, they'll push them out. But that, that's not going to be in your model, right? And would that even further dampen, I guess, the effect of these beliefs on investment? That's probably right. I guess that's what your point there, right?
So yeah, exactly what you said at the beginning, that's summarizing the fact that credit supply matters quantitatively. Credit demand allows these nonlinearities to survive if I have diagnosticity on that side. I agree completely. I also think there's a lot of interesting questions about firm dynamics and diagnosticity or heterogeneity, exactly along the lines you're describing. For papers, any paper that wanted to go in that direction, what I would highlight empirically, given the work that we can do, looking at observable heterogeneity and overreaction across firms, such a paper needs to grapple with the fact that overreaction is quite present for even the largest, most historically successful public firms, and not just the sum tail of a distribution. And so while that's interesting, and I think it likely will matter quantitatively, that's the fact that has to be matched in the cross section.
Very good. Thank you, Stephen.
Thank you.
Time for us to conclude. So many thanks to all the great discussants for their selfless job and digesting the papers for all of us and offering their comments to the authors. Thanks a lot to Tim for running a tight ship today. You can see that when Tim is in charge, things go a lot more on schedule than when I take over. And nevertheless, it's been great to have you all, and looking forward to seeing you all tomorrow for the second day, starting again at 10 a.m. Eastern for 3 papers, including, of course, the keynote address by our new distinguished fellow, Per Crusell, who is here as well today. So looking forward to seeing you all tomorrow.
Thank you.